All right, well, great to be here. Thanks for sticking out the afternoon. So talking a lot about ARR today and AI ARR and monetizing AI ARR. A little bit about myself, if we haven't met. I came up through the ranks of FP&A in the airline and software industry, got into software in the early 2000s, became an in-house SaaS CFO and now fractional CFO, have an academy, newsletter, podcast, all that great stuff. So live and breathe SaaS metrics and finance today. So ARR. You think this would be an easy subject, but it's really interesting. This Fortune article just a couple weeks ago talking about creative accounting, creating our ARR number, and the hottest startup metric in Silicon Valley. Now, I'd argue ARR has always been a hot metric. I've interviewed hundreds of SaaS founders on my podcast, and I always ask, at this stage of your business, what's the top, what metric or operational metric are you focused on? And usually it comes back to ARR and revenue as that traction signal. But you can also get in trouble. There's a company, and alleged, that used a CAR number, so contracted annual recurring revenue, and built that up in maybe a sketchy way, and then that made news because they had some big backers. So we can also get in trouble if we don't properly construct our ARR and CAR numbers. And I also hear there's a lot of clickbait out there, right? And you see all these headlines and titles, ARR is dead, RIP, annual recurring revenue, creative way to calculate ARR. I do like this one by Ellen. ARR is dead if you're still tracking it like it's 2020. It's evolving over time. And it is still a North Star metric. This is the CFO of Rent, a public tech company, that said ARR is the best metric to track our growth. So they manage from ARR down to cash flow. And then we'll circle back on Rent later in the slide deck here. And then you probably also hear this too. SaaS metrics are dead. They're breaking. SaaS is already dead. The rule of 40 is dead. And you hear all this stuff, the shifting landscape of SaaS metrics. And so SaaS metrics are evolving as well. And I had a conversation with Ray Reich, who's holding a roundtable later today, and he reminded me that, remember, Ben, SaaS was a technical delivery model, and really not, it's synonymous with subscription, but really we could call these recurring revenue metrics, and they're changing over time, but they're still very applicable today. But why is this so hard? Why am I spending all this time in revenue streams and in metrics? Because the pricing models have evolved. These revenue categories have evolved. We have subscription, usage, processing, consumption, overages, maybe some outcome-based now. Maybe we're sprinkling in a little managed services. So that's a lot to wrangle as a CFO and figure out how is our business truly performing. And this is the P&L, this I call the modern tech P&L, whether you're software, SaaS, or AI, that I implement for SaaS founders, for AI teams. And it's so important. This is such a powerful tool if we have the proper P&L structure. We've got to have clear and distinct revenue streams at the top. And rarely do I see, I've worked with hundreds of SaaS companies at this point, where the company is offering just one revenue stream. Now, early stage, definitely possible, but usually there are multiple revenue streams, and we can't commingle these. We can't commingle overages with usage, overages with subscription. We've got to get these very, very clear, because it impacts how we set up retention, MRR schedules, all our SaaS metrics. And then now COGS, cost of goods sold, is probably even a harder discussion as I work with these tech teams. And all right, what does it take to support the delivery of your revenue? Do you have tech support? Maybe you're calling customer success, but they're really tech support. Do you have onboarding, and that's commingled with all these other departments? Because we have to understand our overall gross profit. And really the CFO superpower is understanding margins by revenue stream. If we're producing 55%, well, why? What's contributing to that? If we're producing best-in-class 80%, well, also the same thing. What's contributing to that? So we can have thoughtful discussions. So really at this point, clickbait aside, I don't really care if you call yourself software, SaaS, or AI. It really just depends on the revenue streams that you're offering. And trying to figure out, untangle that QuickBooks chart of accounts or Xero to figure out what really are you offering. So where are we going today? Well, one is ARR broken. We'll talk about the evolving nature of ARR. Is outcome-based pricing really happening? And talk a little bit about the AI monetization framework. And I've seen some recurring themes, consistent themes today, especially with Brad kicking off this morning about just that AI fatigue. And they're reporting AI ARR, which is kind of that latest thing on reporting the traction that we're having with our AI products. So is ARR broken? Short answer, no, just being abused. There are a lot of different definitions, but I've done a lot of research on this. And why is it so important? Well, ARR tied to valuation, the predictability of our revenue streams. And that's why you see a lot of SaaS metrics are broken. Well, maybe we have a business model that really truly doesn't fit a recurring model that we're trying to shove in there. So the metrics aren't broken. Maybe you just have a business model that doesn't command those recurring revenue premiums on an ARR multiple. So the big thing, value. You see all these headlines in TechCrunch and elsewhere, $2 billion valuations, $3 billion valuations. Well, that's anchored on something. Of course, a lot of metrics and diligence go into valuation, but are we offering subscriptions, variable revenue, which now I bucket usage, consumption, processing, transaction as variable, and then maybe throwing in some managed services as well. And this was a recent strategic acquirer asking due diligence. One of my clients had some interest from a strategic acquirer that's backed by a very large investment fund that everybody would know, and at the top of the list, car. I say, this was, say, an obscure metric years ago. Now contracted annual recurring revenue is getting a lot of traction. And then ARR, so how do we build that up? How do we present our tech company in its best light without overinflating, getting creative with accounting, even though ARR is non-GAAP, but how do we put that best foot forward to show a true supportable ARR number? And then, of course, the usual suspects here, retention, of course, a big one. And then this is my metrics framework that I used as an in-house CFO, now that I teach in my academy, help my clients with. But the type of revenue streams dictate what kind of metrics we're going to set up. And that's why I say, SaaS metrics are not broken. A lot of these are evolving. For example, CAC payback period, if we have subscription usage, working with founding teams, like, all right, when you land a customer, what revenue streams are we landing? How does that impact the metric, the calculation? If we're PLG, well, maybe we have to look at 6 months down the road. So this is what I implement so we can have some context of what's happening, all those unit economics, to focus on what's working, what's not working in our business. So let's talk ARR definition. So I analyzed 167 public company tech filings to see what's happening on the front lines with these public tech companies. Are they defining ARR? Are they calculating ARR? And then on top of that, research started collecting press release data of global public tech companies, and these could be 30 million and above, and what are they defining? And you're seeing some traction, some momentum here of just these non-GAAP disclosures where they're defining ARR, and they're defining how we calculate ARR. And I thought ChatGPT could do this. I'd just upload all these PDFs, and it'd tell me exactly what I wanted to know, but that didn't work, so I had to go manually through these press releases, all these filings, and with my assistant figure out, all right, what are they truly reporting in their filings? So again, what I was looking for, ARR definitions and calculations. And from the SEC filings, there's a bit of a lack of disclosure, just not defined. There could be various reasons for that. But top revenue model that was disclosed on an ARR basis was pure subscription, no surprise there. And then next up, subscription plus variable, which could be usage, consumption, transaction. And then some were just ambiguous and really hard to tell. They put something out there, but couldn't really tell what they were saying. And then even managed services getting into the ARR definition. And then we'll see, if you're pure usage, what's happening with pure usage in variable companies. And then on the tech side, or the press release side, again, out of those 92, 49 were pure subscription. So building up the ARR on that basis. The next revenue model was subscription plus variable, so that could be usage on top of our subscription that makes up our headline ARR number. And then subscription plus managed services. We'll talk, a little surprised by that. And then all revenue streams, which I don't advocate for, just throwing everything in there and we're calling that ARR, which is really, that slide before where it said, if you're defining ARR like 2020, yeah, you're probably out of style now. So here are the trends that I saw with ARR definitions, those revenue types. So of course, pure subscription, not a surprise. Subscription plus variable, again, that could be usage, processing, transaction, consumption. Also, subscription ARR plus managed services ARR. And then we'll see variable revenue, if you're pure play usage, what's happening with those companies. So these categories, pre-subscription, 92 companies, again, ARR build just on subscription revenue, an example from Rubric there. But one is defining it, two is like, how do we calculate this? So the most popular way to calculate ARR on a subscription basis was MRR times 12. Pretty straightforward. Now we know there are adjustments and RevRec stuff and all that stuff, but just taking MRR times 12, building off our revenue. Now what I found in all these definitions, that a lot of companies were building off of revenue, so they go to their P&L, build up their MRR and their ARR. Others were doing it on a contracted basis. So they'd take their contracted revenue and then add that up to get an ARR number. So it's either revenue-based off the P&L, which is RevRec-based, or just contract adds. And you can see Clearwater recurring revenue for the last month. Now they do daily RevRec, so we got to normalize that, but it's getting to their ARR number that way. Second most popular was quarterly revenue run rate. So same thing, just that quarter times 4, that's our subscription ARR. So you can see completed fiscal quarter multiplied by 4, pretty straightforward. Now next in that what we call hybrid model or SaaS plus model, so subscription plus variable revenue. Now we're taking subscription component and that variable component, combining those two to get that top line ARR number, because we want to take credit for that. We can't just, if we have material usage revenue, we can't just let that sit there. We've got to take credit. We want to create value in our ARR number from that. So the most common way to convert usage revenue into ARR was just that previous 90 days annualized. You can see a Confluent example here. So that was the top method that was defined in these SEC filings and the press releases to convert usage into ARR. Second most common was previous month annualized. Now, I would argue that these are probably companies that have very predictable usage revenue because a month can, we know, be very short, especially if we have volatile usage revenue. But that was the second most common way. And then managed services, kind of a surprise, throwing in managed services on top of subscription revenue. Now, I'm more of a purist, and it depends on the nature of these managed services, but usually, these are people-powered revenue. So we have recurring revenue that's on a subscription basis that's powered by people. I've gone to a lot of SaaS dinners, SaaS events this year, and polled the audience and polled CFOs, and like, hey, CFOs, what do you think? Should we include managed services in our ARR number? And I was kind of surprised. I'd say roughly half of the CFOs raised their hands, like, yeah, I'm taking credit for that if I have managed services. And I'm more of a purist, maybe not, but if I was in a company, CFO, like, yeah, I would want to defend that ARR number. So a little bit of a trend there, that even though it's people-powered revenue, they want to throw that because it's recurring revenue and want to throw that into our ARR number. And then pure play variable revenue, so just if you're pure play usage revenue, could not find any examples of usage companies taking their usage revenue and converting that into an ARR number. Now, maybe that will evolve. I mean, I didn't include it here, but looking at usage companies, they were looking at other things. Of course, revenue run rates, free cash flow, margins, some of those usual suspects, but they were not taking some usage revenue if they're pure play usage and trying to convert that into an ARR number. Now, Toast was the closest, again, bit of a SaaS plus hybrid model. They were taking MRR times 12, and you can see plus the 3 months cumulative payments, and annualizing that to get into an ARR number. So closest I could get. So right now, no pure play usage companies defining ARR. So maybe that'll change. So common business model questions, and I talk to a lot of founders, work with a lot of founders, and this comes up a lot, and we really have to be careful and define this within our company. If you're scaling, is your recurring revenue IP powered, or is it people powered? And it could be a combo of both, but that's a really important business model question that I work with founders on, because sometimes it's kind of confusing. That offshore team, what are they doing? If we didn't have that team, could we really contractually deliver on revenue? And that's important. Investors go through due diligence. We want to know if it's going to take more people than we thought to scale the revenue side of the business. And this gets back to the quality of our recurring revenue. That's why I've set up the SaaS P&L, even AI P&L, to figure out the buckets of revenue that we have, MRR schedules, retention, gross revenue, net revenue retention, customer revenue retention, so we can understand. So we have this P&L, we have all the economics under the P&L, that we can manage our business, and also when we go through due diligence, we're prepared for those discussions, because not all ARR is created equal, as we know. So now, Brad talked this morning about AI fatigue, and I flew in from Scottsdale, Arizona, always shocked when I come to San Francisco, you see all the billboards, like I said, all these tech companies, AI this, AI that, even a bus that was AI, GitLab and AI stuff, and the hype's over. Right? Really, that hype is over now as far as monetization. And BlackRock CEO on CNBC, now this was not a sky is falling type of thing, but yeah, things are a little frothy, maybe a little AI bubble going on. But also on the flip side, Goldman Sachs lead analyst said AI is giving software companies a rebirth, especially at that public tech enterprise level. It's their chance to re-accelerate growth. So we're kind of in this weird phase. And even all of my Yahoo Finance alerts yesterday, it's like, the day before, the stock market's, AI or tech optimism, market's up, and in the morning, optimism's down. Like it's up and down all the time now. So for this, I wanted to know, how are public tech company leaders communicating AI value, right? Because we can't just say, all right, we've got an AI product now, or AI enhanced, or AI enabled, right? We've got to prove that traction. Because Wall Street, they've moved on from the hype. They're asking great questions of these public tech companies, the CEOs, the CFOs, of how are you monetizing AI? And it's just like when I talk to a lot of founders, maybe at the seed stage, you can just get your story can get you seed funded. Series A, it's story plus numbers and traction to get funded there. Same thing with AI monetization. All right, you have the story, now we need the numbers to support it. And so we're kind of at this AI inflection curve where we're moving from hype, where we're really kind of ignored, no reward for that, to monetization. Are we getting price uplifts, attach rates, where we are rewarded with our equity value, to transforming where we're to another level, and now we're valued much differently than the rest of the software companies. So tech leaders, CEOs, CFOs, talking to Wall Street, talking to equity analysts, 5 themes emerged, what they want to know, how they're proving value of AI. One, of course, no surprise, revenue ARR. Can we attach AI to actual revenue or ARR growth? Then 2, adoption. Are our customers actually using AI? And then usage and that value proof. Are we generating good outcomes from AI usage? And then margins. How's this impacting our P&L, our cost structure? And then also product and GTM. Well, we talked about CPQ today. Are we creating SKUs, product IDs, to monetize AI, or is it just a little bit iffy? As a CFO, at one company, I used to control the product ID table. When we created new product IDs, I created that, worked with sales ops, because there are a lot of implications with that. RevRec, how does it post? What GL does it go to? So it's not just creating a product ID, a lot more that goes on with that. And again, we talked about the definitions of ARR, subscription, variable. Maybe there's a little outcome-based revenue happening as well. So real quick, 6 case studies here of how these companies are communicating value. And Appian is an automation company, and what they're doing is price uplift. So they charge 25% price uplift, and right now that's working. That's driving ACV up. And we know for founders that's hard. It's hard to push through a price increase, but right off the bat, they're charging more for AI. And again, what Brad said this morning was true. Obviously there has to be value there. We can't just increase prices, but we have to see some traction there. And the CEO of Appian said, what AI is doing for revenue, it's even doing more for their pipeline. So accelerating pipeline, bringing pipeline forward. And that's boosting subscription ARR. Next example, UiPath, agentic automation. So metered usage tied to AI. So they have clear measurements, metrics, as far as agent runs, workflow runs, how many customers are on AI. So it's not just, hey, you use so many tokens, we're going to charge you for that. Now it's more work-related, work units that they're charging for to show that there's actual value coming from that product. So metered usage tied to AI. And then 5.9 is contact call center software. My very first job out of school, I worked at a call center for a mutual fund company, so this is interesting. So this outcome-based pricing, a little tricky. Is it usage or is it outcome-based? But they're showing the customer impact. Reduction in call abandonment. 50% increase in containment, which is interesting. Containment meaning, all right, when someone calls in, can the software handle that call through the agentic AI or autonomous without having to then push that to a customer. So now 50% less calls going to a person. And then the font's wrong or went crazy here, but 60% reduction in wrap time means, all right, if it made it to a person, that call made it to a person, post-call, they're reducing that post-call workload. I hang up the phone, all right, I've got to do all these actions, so reducing that workload after the call. And I've talked to doctors who see patients in clinic all day, and then at night they're spending all this time doing admin work. And just think about those efficiency gains that you could have with that wrap time, that once you're done with that call, that patient, no admin work after that. And then Zscaler, they're creating categories. Now, they're selling on the risk. Think of all the agentic AI, LLM conversations. That's creating new budgets. We're putting all this, CFOs, all right, we've got a budget for all this AI spend. Now, what about the AI security, agent-to-agent security, LLM conversation security? So they've created a new category to then monetize that through security products. And then CrowdStrike. Now, some of this tech stuff, the hardware stuff, a little beyond me as a CFO, but they're defending their moat, they're defending their network, and they have sensors deployed in hardware for security attacks, and now the AI overlay on that, now they can detect those attacks faster using AI. So defending their moat that they've built over time. And the last example here, Oracle, pushing AI side their core database. So rather, we've talked about SKUs, hey, should we create a new SKU product ID? Maybe we can avoid that whole procurement process. Let's just embed some AI where everybody is spending their money now. Maybe that'll get us through, bypass procurement. We don't have to then go through another go-to-market motion for this. So different ways to bundle, in this case, not additional SKU, but let's put it where the money already is. So again, different ways that public tech companies, CFOs, are responding to Wall Street, to equity analysts. Again, we'll read the examples that we just went through that are boosting subscription ARR, expansion, outcome-based, usage-based, and really having to be clear on how AI is working in their product line. And again, Wall Street's recurring questions. Again, this, if it isn't happening now, trickled down to the private market. I work with private companies, private tech companies, but maybe your board investors, potential investors, will want to know, all right, monetization, what kind of adoption rates do you have? How is it impacting margins? What's your moat? Is it pulling pipeline through? Is it accelerating pipeline? And then also data security and risk. And again, analyst prompts and what CEOs are responding with, quantify your AI revenue contribution. Will AI dilute your margins with these AI products? What's defensible? And the big thing is AI winning new logos, right? What's happening on the go-to-market side? So again, this is kind of the flip side, gaps and weak spots where we can't answer this. No price object. We don't have clear product IDs, SKUs, where we're monetizing AI. No adoption math. We can't show usage within our product. There's a bit of vague value, no outcome-based quantification. We don't know the impact on margin and moats. So the playbook here that we've seen with the public tech company, CEOs, CFOs, 1, monetization, 2, adoption and value, right, then the defend and scale. And again, so kind of a self-assessment here. Where are we on our AI journey? Are we still in hype, where we're just talking about AI, the vision that's on our roadmap? Are we actually truly monetizing it, showing usage, showing attach rates, improving our pipeline? And then also that next stage is transformation, our value. So again, now AI doesn't get us valued. It's that AI economic framework through those different examples that we're showing that this is truly accelerating revenue and value within our company. Now, a couple more slides before I wrap up today. So what about reporting AI ARR? An earlier slide, I mentioned the Verent CFO, who said ARR is a North Star metric. And they were probably one of the best companies that I saw out of all the disclosures as far as disclosing ARR in their SEC filings, their press releases. And they're about $800 million in revenue, and ARR is their North Star metric. Total ARR, so they disclose total ARR as $728 million, so all revenue, recurring revenue streams. And that was only growing 6 to 8% a year, so single-digit growth. And then we have AI ARR. That's growing faster, so they're breaking that out. And they said, all right, anything that has AI functionality, we're going to segment that AI ARR. And for them, it was a mix of subscription and usage revenue. And that was growing faster than their revenue base. Of course, they would want to disclose that, show value, proof to the street that their AI initiatives are working. And again, a lot of reasons, it show AI, how it's monetized, ROI for the consumption, and even showing current customers and expanding that value. They said a healthcare customer increased AR from 8 to 15.6 million. Just showing that the AI adoption is working. Now, it's probably not because of their non-GAAP disclosures, but they were acquired in August by Thoma Bravo. And maybe it was showing, all right, we are seeing AI, ARR adoption and traction, and then they were taken off the market in August. And then finally here, what about outcome-based pricing? A lot of hype around this. So what I've found, just what companies are reporting, it's a bit of a slow evolution. Now, sometimes it's hard to tell usage versus true outcome-based pricing. But in the SEC filings, there was, out of 167 companies, only one company, this bank operating software, actually explicitly mentioned outcome-based pricing. And they moved from a seat-based pricing to outcome-based pricing. They felt that was more aligned with the value that their customers were getting. They're about $500 million in revenue. So again, same thing, nCino aligning prices with customer outcomes. And again, we'll see how that evolves. There's a case study before of just the outcome-based, the call contact center software. So we'll see outcome-based pricing. Still, as far as the language out there, not seeing too much of that yet. So that's it for today. If there are any questions, anything after this is my email. Feel free to email me after this, ben@SaaSCFO.com. Happy to answer any questions, provide slides, anything like that. So I appreciate your time today. Thanks, guys.